I think we should talk a little bit about the US debt ceiling. I just wonder, Rob, if from your perspective, is this something that you're worried about? I've sort of said here in the past that it doesn't make sense for the United States to have an issue like this because it's all downside, but just because it's not in US interest doesn't mean it's not going to happen. We just saw from Russia how much countries will do things that are not in their interest because a leader thinks something is wrong or because of internal political dynamics.
Well, I think there's two ways you could tackle that. The first is from a financial markets perspective as an investor. And the second one is longer term because, just this morning I got an email from a client saying, hey, I'm really worried about the dollar. Can we have a discussion to talk about what's going on? And that seems to be the zeitgeist, as you pointed out. Everyone's concerned about this. So let's take each of those in turn. First, on the investment side, which is more tactical. So we've had multiple meetings specifically to talk about this internally and just make sure that we understand what's going on. And essentially, the way that we're positioned right now, in full disclosure, is we have a big position in short-term U.S. Treasuries, T-bills. The yields on T-bills is really good right now. It's over 5%, 5.2% in that area. And the concern is if you do have a debt ceiling breach and you have a technical default, then the duration that you'll get on those T-bills, you'll have to wait a little bit longer to get them paid. But for most people, it doesn't really matter. Like, even if it's delayed a month or two, for all intents and purposes, it's the same thing. If they do have a debt ceiling breach and they have a technical default, you probably will see at least a modest sell-off in stocks and risk assets and credit spreads and stuff like that. It's a little bit hard to dictate or to predict because the notion of the risk-free asset is so ingrained in all finance theory that if the risk-free asset, even if it's just a technical one, has a default, it's sort of a little unpredictable. It's sort of like building all your institutions on the understanding that there's gravity, and then gravity turns upside down and everyone's flying up to the ceiling. So There's a little bit of the unknown unknowns, but I think for the most part, it's fairly mild, any actual ramifications in the short term. So that's how we're positioned, and that's sort of our take. In short, not a huge deal. The bigger question that I think more people are interested in is, well, is the dollar losing its reserve currency status? Is the dollar becoming weak? And this is, I think, an area that's so ripe with misunderstanding, misinformation, because it's so unintuitive, some of the key aspects that drive the dollar strength. So let's just break out some of those and talk about them, right? So first of all, I'm going to bring up the name Michael Pettis, and we're going to have an argument right now. But
no, I like Michael Pettis. It's good.
Just for background, Jacob and I have been having a lot of discussions about Michael Pettis recently. But I think he's right in pointing out, and I really like Michael Pettis too. He's right in pointing out that the dollar strength is not necessarily a good thing. It's not necessarily a sign of, the U.S. is so healthy and that's why the dollar is strong. And therefore, if the U.S. is not healthy, if you have people storming the Capitol building, if you have a technical default, that the dollar is going to be necessarily weak. The dollar is strong because we are the only country that's big enough and liberal enough in accepting capital from abroad that you can put your funds here. So, for example, right now, people with money in all of these countries that we spoke about, Sudan, Pakistan, they're desperate to have dollars. They're desperate to get their money out of those countries. And if you put that together, where are you going to go? What are you going to buy? In aggregate, the U.S. is the only capital market that has the depth to accommodate the flows of people who want to have a reserve asset. The bigger thing is not individuals like that, it's states. So states like China and Japan that run chronic current account surpluses so trade surpluses. They run those trade surpluses because of policy levers that they've pulled in their own economy. And as a result of that, they need, we always think of the current accounts in terms of the trade side. Yes, they export more than they import, but the corollary of that by necessity is they have flows of capital that they need to shoot outwards like a fire hose. So who's going to accept that flow? The United States is the only country that can and will. We're the only country that's big enough. We're the only one with liquid financial markets. Even Europe, arguably from a GDP basis is about the same size as the US if you take Europe as a whole. But the way their financial markets are structured, you have German boons, and then, very quickly you run out of kind of safe stuff to own, or liquid stuff to own, because Europe has a lot of debt. A lot of it is owned by the ECB. Or it's in countries that are kind of, you're like, well, that's a little weird. I don't know if I want to own so much Italian debt, for instance, right? So the whole point is the US dollar strength is the outcome of the global system that we've lived in for several decades now. Those countries are not going to turn around. Like, everyone always assumes it's like a moral story. Like, oh, are they going to punish us by not buying dollars anymore if we're too stupid, or we shoot each other too much, or we burn down the White House? No, they're not going to, because there's no alternative. And I think that's really so hard to wrap your head around. It's not a moral story. It's not a judgment call about the US. It's an equation, a mathematical equation, and the only potential outcome after the equal sign is buy US dollars. And until something fundamentally changes, and it probably won't be on the US side, it'll probably be on the other side. So, some fundamental shift in the Chinese economy, where they're no longer running structural current account surpluses, where they change policies to kind of durably consume more, which isn't on the horizon, but at some point they probably will have to, because it's not sustainable otherwise. That's when the dollar will fundamentally change. But in the meantime, all of this stuff, we can do lots of crazy things, and the dollar is not going to suffer as a result of it.
Well, you were talking about the 1970s at the beginning of the podcast. One of my favorite charts to show people when I'm on the road is, look at dollar strength over the past 10 years. Looks like it's been going up quite a bit, but then look at the dollar strength going back to the 1970s, and we're relatively low compared to we were in the 1970s. So, like, when you think about there being room to run, there was an interesting article. I don't know if you got a chance to see it on the Knowledge platform yet,